Welcome to Barchart's series of educational webinars designed to enlighten you on a variety of trading and investment ideas, demonstrate the pages and features Barchart provides related to these concepts, and offer some traders insight to help you make a more informed decision. Today's session, earn income with bear call spreads, the secret weapon for bearish traders. The bear call spread is a powerful yet often underappreciated option strategy for bearish traders. It offers the potential to profits from falling or even stagnant prices, all while limiting risk and avoiding the large capital requirements of shorting stocks. While profits are capped at the credit received, this defined risk approach offers strategic advantage over buying puts, which requires a significant downward move just to break even. The bear call option spread is a high probability way to express a bearish view with eliminating capital costs and lower volatility exposure. Hello everyone, my name is John Rowland, Barchart Senior Market Strategist. And as I mentioned in the opening, this limited risk, limited reward, bearish options strategy has a number of advantages over traditional bearish strategies like buying puts or shorting stocks. The most distinctive is that you don't necessarily need the underlying price to move in order to become profitable. And today we're going to look at the updated Barchart bear call screener and offer some navigational tips and tricks and insights to help you find the right combination of risk, reward, and potential high probability bearish candidates. Now, before we venture into the bear's cave, please welcome our moderator and Barchart's project director, Gene Baker. Hello, Gene.
Hi, John. Keeping cool over there?
I'm trying to. I mean,
Yeah.
I was telling you beforehand yesterday, my thermostat said that didn't give a temperature, just said it's way too hot.
Yeah, it is way too hot. Time for a little cool off, I hope.
I think a little lemonade and hopefully a little poolside if you have the opportunity to do that, right?
Right. Yeah.
All right, Gene, let's jump into it before it gets too hot outside.
Okay, let's go.
Let's get it going. All right, remember today's session is for educational purposes only, and decisions to buy, sell, or hold securities, commodities, or other investments involves risk and best made on the advice of a qualified financial professional, and under no circumstance shall we be liable for any loss or damage you or anyone incurs as a result of any trading or investment activity that you or anyone else engages in based on any information or material you receive through barchart.com and or our services. Okay, so before we jump right in, let's start with some fundamental understandings of the principles of bear call spread before we take on some advanced details and some trade construction. So first of all, a bear call spread is a limited risk, limited reward, income generating strategy and is best suited for traders with a bearish sentiment who believe that the stock price will decline or at least trade sideways. Since the short call, the one we're going to sell, leg one, strike is closer to current price than the long, the one we're going to buy, leg two, strike, a credit is generated. Now, the maximum profit is limited to the original credit received and fully realized if the stock price is below the lower strike at expiration. So to achieve maximum profit, you need these two conditions: price below the lower strike and expiration. That means that at some point before expiration, we might exit the trade and not receive maximum profit. Now, if you anticipate a precipitous drop, then buying puts would be more advantageous. Maximum risk is the difference between the two strikes less the original credit received. This is our limited loss. And break even occurs if the stock price is above the lower strike by the amount of the original credit received. Now, one of the key elements of our trade setup is that we will try to place our break even at or above a level of resistance that could be found in the lower time frame near current price, and setting our higher strike at or above a level of resistance at the higher time frame, for instance, a significant swing high. Now that will set about a philosophy of this type of option strategy. And so those traders who are bearish or have a bearish outlook will achieve greater profits by choosing a short call strike slightly in the money. And the maximum profit would only occur if the price falls below the lower short call. However, the trader will incur a greater risk if the stock price does not decline, and a rise in stock price could result in something called early assignment. A trader who is slightly bearish or believe the stock is in a range bound or sideways will be better off served by choosing a short call strike at the money or slightly out of the money. Now, this is a more conservative strategy and will result in smaller profits, but the trade only needs the stock price not to rise above the short call to become profitable. Now, I'm going to offer some ideas about percentage of in the money at and out of the monies, but it really does come down to the individual trader, their bearish sentiment, and the price structure of previous price action and risk tolerance. Think of it like the setup as a sliding scale or a seesaw. The more bearish, then the closer to current price in or at will equal greater profits, but at a disadvantage of greater risk. And the further away from current price reduces your profits, but increases the probability of success, therefore less risk. So let's talk about, I want to offer you some simple checklists and technical analysis concepts to help in the candidate selection process before we break down and learn how to make adjustments to the bear call screener. So the first one is, we're going to pick on the weak, so to speak. We're going to choose stocks from sectors with a negative relative strength compared to other industry or sectors or the broader index. Now, if you don't know how to do that, let me go back to Barchart here. And I'm under the stocks market performance. And you're going to get this nice little graph here. And this is basically gives you the performance of the 11 sectors in the S&P. And you can adjust it by, this gives us over 1 year period, but you can adjust it by sliding this on the bottom here. Whoops, here we go, an update. We're going to get an update. And the black line represents the S&P. So any of the colored lines below the S&P would be underperformance. And you can see down here, we have 3 sectors that have negative performance for the last year. And that would be materials, energies, and healthcare. And so what you could do is you could go to, like, for instance, here's healthcare. And you could look in there and see which are the constituents, the stocks that are in that sector. And then you would be concentrating on looking for opportunities in some of these potential stocks. Okay, so that's one little trick you can use. So another thing we can do is we can patiently wait for the stock to fail or to hold a recently new high. Now, a lot of stocks are making new highs in sympathy with what's going on with the broader market. So if they fail there or start pulling back, these might be better candidates. Or if a stock penetrates an old support level. Now we can use technical analysis. Low volumes are indicative of the markets that are in sideways action and then might be good candidates. MACD crossovers, negative momentum. Mean reversions. Now you could talk about mean reversions in terms of positive mean reversions or negative mean reversions. Positive being waiting for the market to return to the mean and looking for better opportunities or timing, or negative reversion where we're looking to capture that momentum. RSI diversion signals, again, a technical analysis tool. And these all can help with your timing. Look for candlestick reversal patterns in lower time frames. Now, this is going to help us in another way too, is the location of these reversal patterns could help us in determining some strike selections, particularly the short call. All right, so there are some important components to this strategy, and one of the concepts is time decay, or known as theta. So theta is a term that refers to the rate of decline in the value of an option due to the passage of time. Now, it can be referred to as time decay, and this means that the option loses value every day, and in all things being equal, as we move closer to option expiration. So the passage of time is a strategy's advantage. And so the theory behind theta means that the decay increases exponentially within 40 days of expiration. And so in this sense, what we want to do is we want to set our trades with shorter days to expiration. Now, if I choose a strikes above current price, then the value of the option is all extrinsic. In other words, time premium. Now, if I set an aggressive spread and choose our lower leg in the money, then the premium value, the credit, is a combination of intrinsic, how much it is in the money, and extrinsic, that time premium. Now, the reason why we need the market to move lower in order to capture more profits in a in the money scenario. But my preference is somewhere slightly at or out of the money. And I want to look for that benefit of time decay as my ally. In other words, all time premium to my credit. Now, this is just a trader's preference and is part of that sliding scale concept. Another important aspect to this trade and part of our trader's performance is called net delta. Now, net delta helps traders gauge directional exposure and helps us in selecting strike distances. Now, for example, if I'm placing a short call at a delta of, like, say, 20 or 30, that often reflects a high probability. Now, what do I mean by that? Well, delta is a representation of how much that option is going to change with a $1 move in the underlying stock, but it's also a representation of probability. So a call with a delta of 20 says that there's about a 20% probability that that call will finish in the money. But we're selling that call. So that tells us that the probability is 80% it will not finish in the money. In other words, a high probability that our trade will be successful. And we are far enough from current price. But the trade-off is that it often means that we're not getting a lot of premium. So again, lower deltas decreases the loss probability, but the trade-off is lower credit received. So the long and short call delta differential, the net delta, helps us adjust this exposure and set our parameters, allowing our trade to balance reward to risk. And again, in one of my preferences, I like to discover candidate setups where the net delta is somewhere between 25 and 35. Now, I find that these offer good reward. Yes, I'm a little bit closer to current price, but if I position them correctly, my two strikes, be it with my break even, my upper strike, with technical analysis, then the probability of loss decreases. And I'm getting paid for having a correct bias opinion. So let's do this. Let's go to our options page. So if you're not familiar with our site here, under options, under vertical spreads, you have bear call spread. So let's open that up. And it's going to generate some ideas for us. And we've got 396 potential ideas. So let's go I'll go over some of the mechanics and also some of the features that are on this page. So first of all, if I click on this plus sign here, this allows you to quickly look at a chart, and this is going to help you to determine price characteristics. Is the market going up, down, or sideways? But it also allows me to kind of eyeball levels of resistance. In this case, it looks like there's a little level of resistance in Apple here around the 206, 205 area, and another level of resistance look around 214, 215. So just off the bat here, if I was thinking about a bear call spread, I would be thinking something like the 205, 215 spread. Now, one of the things you can do here is you can sort by symbol, and that's what I'm going to do here. I'm going to sort by symbol, and I want to get all the apples up front because let's see if we can find that 205, 215, and there it is, 205, 215. So if I click on this little symbol here, this little icon, what this does, it opens up this panel, and this breaks down the trade visually for me, all the different components. So here under the profit loss, you get a lot of nice information, the trade setup. What we're going to concentrate on is two key elements. One is the break even. Now notice in this instance here, the break even price is 207.68. So remember when I just eyeballed that, it looked like the first level of resistance was around 205. And this is kind of what I was talking about. We want to find a trade where our break even is above a potential level of resistance. In theory being that that level of resistance will keep price lower and away from our break even. The other one we're going to concentrate on is our risk reward ratio. Now, ideally, I like where I can find credit received, which is about 1/3 of the spread differential. So for example, if I had a spread differential of $1, then I would want to collect about 33 cents or $33 in the case of options. But that is not always possible, right? But think about this. A third, 33, 1/3 versus 2/3, or 2 units of risk to 1 unit of credit. So an ideal ratio would be around 2 to 1. Again, this is not always achievable. So sometimes when I'm setting these trades up, I will give myself a variance of about 80% of that credit to the spread ratio. Or unless I take a different or more aggressive tack and set my short in the money. Now, above 5 to 1, then, again, this is a trader's preference. These will be high probability percentages of success, but what we're doing is we're picking up nickels and dimes. Now, I'm not disparaging this. I'm just saying, and I know there's a lot of traders who do trades like this. They do that kind of that nickels and dimes scenario. It's just not my style. And again, that trader's preference. Under Greeks, we're going to look at 3 things. First of all, net theta. Now, net theta is going to tell us how many cents per day this option is going to decay. Net delta, well, we just talked about that. And then the delta to theta ratio. Now, this is just a comparison. And the general rule here is that the lower the ratio, the greater the decay. So looking at this potential trade, we have a nice net delta, which I like. right in there in my 25. And my delta theta is, about 5. That is a good number as far as I'm concerned. Okay, expected move. So what an expected move does here is it helps us align our strike selection with our technical analysis. And what we're going to look at is the high end of the worst case scenario. In other words, where is the market pricing in the potential of this option to go? Well, again, this might give me an opportunity to adjust my strikes. I might be able to lower my let's say my upper strike. Remember, we were just looking at the 205, 215, but here it says expected move is below 210. So maybe I could lower that. But that lowering that upper strike will decrease my credit, but that might give me the opportunity to lower also my lower strike, move it closer to current price. So maybe a 205, 210 could turn into something like a 202 and a half to 210 spread. Again, it depends on this expected move that allow us to make that selection. But it is certainly a good tool for determining our upper strike. We'll talk about volatility a little bit later, and then trend. And again, here what we can see is, for instance, for Apple, it is showing us some strength in the short term. Now, that only will add value to our calls, but overall, you can see that the medium and long term is down. Again, something that we want to try to do is pick on the week. So here you can see Trend Seeker is saying this is a sell. Now, a lot of these trade setups, it's okay if you see the Trend Seeker say hold. All right, so let's go back and I'm going to open up the filters. First of all, again, we saw that we had, what was it, about over 300 or so. And I just want to kind of go through some of these filters here. And we're going to make just some small adjustments to our bar chart defaults. And we'll see if we can't narrow that field of candidates down. All right. So the first one, it says trend signal. We saw it was a sell. So like I said, it's okay to add hold. Now, if I add hold, I'm going to bring in more candidates, but we're going to make some adjustments and we're going to decrease those candidates. All right, so the first one here is days to expiration. Notice this 1 to 60. Well, we just talked about theta, that theta decay. So let's look at those that are 30 days out and where decay is starting to pick up. Now, below here, it does say monthly and weekly expirations. Now, this is a strategic choice. So picking the monthly expiration means that we're probably looking at for a better liquidity purposes, especially when we're exiting a trade. If we're going to get exit a trade, we want to have some good liquidity. Now, if you're trading large mega caps, then they're obviously going to be able to support weekly options trading. But there are a lot of large cap stocks whose average options volume is confined to the monthly strike. So again, this is just, again, a trader's preference. And so one of the ways we can do that, or to define an opportunity to trade options other than monthlies, is we could look at volume and open interest. And that's a great way to define a potential risk, so to speak. Then what else do we have? Oh, moneyness. Well, moneyness is where our first leg is in terms of current price. And so in this case, what we're looking at is a 0, meaning right on current price, to negative or out of the money. Okay, so that's our defaults. Now, what I'm going to do is I'm just going to add one element to our screener. Under options analysis, delta, we're going to add net delta. And we've already talked about this. that, again, trader's preference, I kind of like to find between 25 and 35. But, you know, let's widen the field just a little bit. Let's narrow this down a little bit. So let's pick a field that's between 20 and 40 and see what our results are. Okay, so we have 147 potential trade setups. Now, before we go and look for that Apple trade, I just want to kind of show you something here. Now, yeah, that's 147 is a lot of potential trade setups. But again, if I go to my flip charts here and I pull this up, on top of here are the symbols of the candidates. Now there's about 30 symbols in this top ribbon, and you can see it ends here with Coca-Cola. So if I can continue to go to the left, you can see that there's really only about 32, 33 candidates right now for us to look at. So yeah, it says 147, but it's really only about 30 candidates. Okay. So again, here I'm in Apple, and there, where did we see it? There it is. There's that 205, 215 call spread. And again, you know, what are we trying to get here? Looks like a max profit of about $2.76, right? And yeah, look at our risk reward. It's about 2.62. You know, not that 2 that I would prefer, but certainly close enough for me. And you can see that our loss probability in this case is only about 31%. It means that that is a percent of what percentage of this trade not working, but that also means it's about 69% that this trade will work. All right. So I'm kind of looking at this, and let's go back to our flip chart. So I just want to see some of the candidates. Remember, we kind of looked at, we said we're going to kind of pick on some of the weak. So I do see AbbVie here, and I do see Johnson and Johnson. So let's go to Johnson and Johnson for a second, and let's just look at it as in terms of our chart. So what could we do here? Well, let's look at this in terms of helping us to define potential candidates. So what do I have here? Well, I do see a market that is in a nice down sloping trend. Right now, it looks like price is kind of trading sideways. We're making lower highs and higher lows. And it looks like there's, in the daily time frame, it seems like there is a lot of resistance here around the 158 level. Now, what we can do here is then go down to a lower time frame. I'm going to go to a 30-minute time frame. And here is a nice reversal candle, right? Now, this might be a candle pattern that you are familiar with, but think about what is going on here. When the market goes up, finds resistance, and goes down. And why do I like this? Well, because the green candle is the close of one day, and the red candle is the opening of the next day. But also, if we look at price action at this time frame, it is a level where price has broken through a level of support. So here, that value is 155. So if we were going to construct a trade here for Johnson and Johnson, well, I would think that something like a 155, 158, or maybe we might not be able to define a 158 strike. Maybe we have to go to like the 160 strike. So let's see what the screener says. And I think I'm going to have to go to, oh, there it is. So notice it gives us the 155 for 160, and I swear to you folks, I did not do this. The screener is doing it for us. But again, look at what this trade is telling us. We're going to get $1.34 credit, 270 2.73 risk reward ratio, and look at our probability, low probability. If we break this trade down, again, look at our profit and loss. Where is our break even, right? Our break even in this case is 156, well below, well above our first strike, our 155 strike. So this would be a good sign that the resistance that we have discovered at 155 should keep the price down, and it is below our break-even value. There's our risk reward. What's our expected move? Well, look at our expected move here on this one. So our expected move is 157.55. So this could mean that we could roll down. Maybe we could look to bring our higher strike down, but that might decrease our credit. But we could maybe roll down our long leg, our short leg. And what is our trend? Well, again, short-term, medium, and long-term, all showing weakness in this particular example. All right, so let's go back to the chart here. And this is what I said I'm going to try to do with you folks is, okay, so here's MACD and RSI in these are my templates. And again, look at the MACD. Negative momentum below the zero line, that is a good sign. And the RSI, it has turned up just a little bit in the last couple of days, but again, below the 50, that is more of a bearish indication. I'd be more concerned if it was above 50 or maybe even above 60, but it isn't. So again, there's some more technical analysis that is supportive to the ideal of this potential trade. Okay, let's go back to our spread here. All right, so those of our screeners. Oh, let's go back to J&J for a second. I just want to do one more thing. So let's just pretend, for instance, that we did want to modify our trade, or we thought maybe we could do a little bit better job than the screener. So I can go to under vertical spreads, and there's bear call, and we're going to pick that July expiration with 23 days out. And so, yeah, again, look here, we can see here's a 152, 162. But we just said that we could lower that down. Maybe 152, 157 and a half might be good. Now, here we see our default views. This is what is being picked up by the screener for this individual stock. But if I wanted more candidates or more selections, then I could change this to show all. Now, one of the things you could do is sort this by leg one, and you could say, well, let's do the 152.50. Oh, not 153, 152, 52.50. And then it's going to show me all the 152s, 50s, and there you go, 152.50, 157.50, and look at that, we're getting almost $2 on a $5 spread. And look at our risk reward, well below our 2, but notice what happens. Our probability of loss goes up. Again, that sliding scale and that potential trader's preference. Okay, so let's go back to our screener here, and let's see if we can make some improvements on this. And again, what I'm going to do here is I'm going to go through my process, the settings of my preference, or again, my philosophy. I'm not saying that my philosophy or preferences are right. It's just what I'm trying to achieve. And when I go through this, I just want to let you know that the screener that I'm going to show you will be embedded inside of the slide deck today. So when this video becomes archived, you can download the slide deck that goes with it. All right. So I've gone into bear call spread here, but I'm going to go to the bear call credit. This is my screener. that I developed. And so let's look at some of these inputs and we'll talk about them. Okay, the first one I've added is last price. Now, last price will be found on the screener as is, but here what I'm doing is I just want to know where price is. And when I go to the filters view, which I'll show you, I want to be able to see that. The second is my short-term signal. And again, that can be found in our bar chart opinion. Then I'm going to look at volatility. Now, looking at volatility, the more the volatility we have, the higher the volatility on options. This always relates to more time premium. That's good for us for our credit. But again, I don't want a lot of volatility. Now, again, this could be a trader's preference, right? I'm kind of being a little bit conservative, but I'm going to show you a way how to be conservative and look for premiums. But if you are a credit spread trader and you understand volatility, then you might want to set this at, let's say, 50 to maybe 100%. But what I'm going to do here is I'm going to look at where is my volatility and how is it ranked to the individual stocks. This puts implied volatility into a perspective. Again, the higher the rank, the higher the premiums to that particular stock. So again, I'm going to be looking for ranks above 50%. Moneyness. Now I have a little bit wider window here, 5% in the money to about 10% out of the money. Again, depending on my mood, I might narrow this one way or the other. If I feel the general market is in a bearish tone, I'm going to probably be a little bit more aggressive. If I'm fighting a general market bullishness, which we're kind of doing right now, then maybe I'll be a little bit more conservative and looking for something that's a little bit more out of the money. Net credit. Again, I'm not a fan of chasing nickels. So here I'm just using a kind of a threshold of a net credit of around $1. But again, when we do this, when we start looking at strike differentials, notice that my strike differential here starts at 3. So $1 for $3 worth of a spread. Again, that 1 to 3 or that 2 to 1 risk to reward ratio. Now, if you are trading high cap stocks that trade higher prices, then you might want to widen this. That'll bring in a lot of those higher price stocks. But you could just literally just eliminate the 10, and then you'd have a price range of 3 to whatever. Net delta, we've already talked about that, between 20 and 40. My net delta theta, again, this is just a ratio comparison. My days to expiration, again, 1 to 30. And you can see here, I have added into that weekly expiration. So for me, volume is not a concern for me, especially if I'm going to stay in the large cap world. To me, I believe that open interest is a good measuring stick for liquidity. All right, and so let's see what our results are. All right, again, 139 candidates. And again, if I go to my flip charts, look what we get, right? Less than 30 potential candidates. And again, I could look at these in terms of looking for a very particular stock or a stock that is in a particular sector. And I don't see anything that really kind of jumps out at me at the moment, but I do see, it looks like there might be a couple of materials here. There might be one energy stock in here. Well, this is what we're going to do. We're going to come back into the screener here, and we're going to go to our filter views. We're going to look at those filters that we just set. And I'm going to sort this page by our implied volatility rank. Now, notice what happens. Remember, we set this implied volatility between 20 and 60, but now I'm looking at rank, and now I'm looking at a lot of these candidates. The implied volatility is at 100% ranking, right? Again, for those who understand volatility and credit spread trading, we want to sell high implied volatility. And in this case, this is what screener is helping me to do. So from there, I'm going to look at these three inputs: strike differential, credit, strike differential, and my net delta. Now, I'm just kind of eyeballing some of these here, and I will admit that I did preset a couple of trades just kind of working on this morning, but this one's new. This is relatively new. So there's $1.20 on a $5 differential. Again, close. $5. You probably want to get closer to about 150. But there, nice delta, and look at that low delta theta ratio. All right. And where is the strikes? Well, you can see the strikes here, 160, 165, slightly out of the money. But I did see one that really interests me. Let me see if it's still on the board. Okay, I'm going to need to go to the next page. And of course, Gene, right? You set something up and then boom, the market changes on you. And so it's not there. That's okay. I got a second one. All right, the second one, let's see. I thought it was up here. Let me just check. Nope, it's not there. Okay. All right, so the second one I thought about looking at was PepsiCo. All right. And it was the 132, 140. So let's see if we can find that one. So that'd be on the previous page. Uh, 132, 140. Okay, so let's break this trade. Okay, let's look at our chart. All right, so again, where's our most recent level of resistance? Right there, around 33, 132, and then 140. You can see that's an old level of support that has now broken down. Look at, where is it? Right there. We'll look at our mechanics of our trade, 132, 140, right? What's our break even? 133.56. And in this case, we have a risk reward of 4. Now, again, below our 5, but maybe closer, not close enough to our 3.2. So let's see what our expected move is. Our expected move is 134, so that probably means we could roll down a little bit lower. So let's go to a chart. Let's go to a bigger chart. And it was PEP. Okay, so there's our 132-ish. All right. And there you can see that 140. There's our 140. Again, I think this would be a fair trade to do, but let's go to a lower time frame and see if we can find maybe a little bit of candlestick activity. And yeah, I see a lot of interesting stuff here. I see, a rising star, rising star, shooting star, I guess, shooting star here. And then again, a gap down here. So, maybe what we could do is we could roll this down and do maybe say a 135, 130 call spread. So let's go to our individual stock, bear call, change our expiration. And again, look at here we go, nice 132, 134, right? Much better, 2.85. 132, 135, again, 2.85. You know, maybe we go even lower. We could do something like 130, 135, 2.25. So again, the preference of my screener had led me to potential trading opportunities. Still want to do that mechanics, right? I still want to break down that trade based on where I'm going to set my break even, where I'm going to look for that implied move. And then again, we could look at some technical analysis on this one. Negative RSI, looks like we're getting a negative crossover now here on the MACD in the below the zero line. That is bearish. So some good technical analysis that'll help us with the trade. Okay, so I want to talk about some additional risk and some final thoughts here, but I do see some questions adding up here, Gene. So give me a second here. I want to see if I can get through some of these. I think some of them have been answered as I've kind of breezing through these.
So while John reviews the questions, I just want to let everybody know that to run the bear call spread option screener and actually all the other option screeners on our site, you will need a Barchart Premier membership. We offer a free 30-day trial. If you haven't already signed up for Premier, you can try it out for free and check out everything that John is teaching you today. Great learning experience using that free 30-day trial.
Yeah, I agree with you, Gene, especially if you really want to, you know, take these screeners for a test ride. So here's a question about looking at the healthcare sector, and the question basically says that, you know, there are some candidates in the healthcare sector that do have a 100% buy signal. Are those better candidates for bear calls? So again, you know, what is our ideal? Our ideal is that we want to be, you know, we want to pick on the weak. We have a bearish sentiment. So do I want to pick on somebody who has 100% buy recommendation or buy opinion? Probably not. Not unless I have a lot of technical analysis that is going to swing in the bearish sense. In other words, you know, a failed making a new high, or that RSI divergence, right? Or a MACD crossover that could tell us we could be in a very short period of time where we've now had an impulse and we're having a correction in a bull market. You know, that's how you could look at it. But again, the theory behind why we want to take these trades is we have a bearish sentiment. Now, on your favor on this question is, will the calls probably be a little bit more valuable in a market that is rising? Yeah, I think they will. But again, what we want to do is find that balance between a good credit and that high probability. And so if I'm fighting trend, that's not a good high probability candidate in my mind. Gregory asks, I don't want base technical readiness based on trend seeker. Do I have the ability to alter the technical indicators? So Gregory, yeah, you can. You don't have to rely on the trend seeker. The trend seeker is just a combination of technical analysis. It's one of our proprietary ones. It takes in volatility, it takes in average true range. So it has a lot of benefits to it, but you can do technical analysis on your screener. And again, technical analysis either on very specific tools that you want to look at, or you could base it on a moving average, or you can make it on new highs or lows. So there's a lot of ways you could do that. And again, under the opinion or chart opinion or opinion indicators, you can adjust by, if you want to just look for stocks that are below their 20-day moving average or below their 50-day moving average. So you can zero in on what technical indicators that you're interested in. Okay. So there's a question about that. It seems that all strike price, and this is from KL, that all the examples I showed, it seems that all strike price combinations, the max loss exceeds the max profit. And that's the mechanics of this particular trade. You're going to collect a credit that is going to be less than that spread differential, or probably a large percentage of it. Now, if you wanted to get where you're at even, or even a greater credit for that spread differential, well, what do you have to do? You'll have to sell a call that's deeper in the money. Probably something I wouldn't want to recommend, but that's how you can do that. If I'm selling calls that are above current price, then you'll always see that your credit will be, your max profit will be less than your max loss. That's why we want to be at that 2-to-1, okay? I got a couple nice comments here. Thank you, I appreciate it. So how do I get expected move from, how can I get expected move for a setup that I choose? So not profine from one of your list. Okay, so again, let's go back to our options, call spreads again. Here is that bear call, and this will give you that expected move. Now, I'm assuming what you're asking is you're going to create one of your own and then you want to look at it. So you really need to find the corresponding inputs for the spread that you're going to create. And again, the way you could do that is you could go to any individual stock that you're going to do, and then again, when you get to the bear call candidates based on whatever expiration you choose, and you have a default, if you don't find the combination that you like, what you can do is show all and then pick either the leg one as your one side and then look at all the combinations based against that leg one, okay? And then you can still get that expected move, okay?
Hey,
All right,
John, I also want to point out there's an expected move selection in the left navigation. Right there.
Right there. Very good, Gene. And this is really more expected move for all the options for
Correct.
for that particular expiration. So that would be another way you could do it too. Okay. All right. I see a lot of other questions. If I don't get all to your questions, do me a favor and just send them to support@barchart.com. Again, I always say to you guys, we have a great support staff, and a lot of our support guys are former options traders, so it'll help you with, I see a lot more about mechanics here. Okay. All right. Let's do this because we're running out of time. All right, some final additional risks I want you to be aware of. Okay, first one is early assignment. Okay, so this generally occurs if the stock price rises above your short strike, where the intrinsic value makes it profitable for the call purchaser to exercise. Now think about exiting a trade if the short strike is in the money and has little or no time premium. the probability that this candidate would be for assignment. Expiration risk. Now, expiration risk occurs if the stock price is at or slightly in the money at expiration day, and the trader might have to establish a long position to buy to cover to anticipate that short position. Now, but let's think about it like this way. Price is bouncing around the lower strike the day of expiration. Now, if exercise, remember the conditions of an option, if you sell a call, you're giving somebody the right to buy, you will be short. And so you'll be short the underlying. And in order to flatten your position, you might have to buy the stock to offset that short position. Now, but that stock might not settle deep enough into the money to warrant that trader to exercise or advantageous to your options purchaser to exercise, which means you might be left with a newly long position in the stock that you originally had a bearish sentiment on. And your risk could be is that the price could fall the next day on that. Now, could you easily buy back the short call? Yes, that is obvious, and that's why our best practice is as we're getting closer to expiration, right? Then let's just close out that trade. So again, a general rule that I use is if I've collected 80 to 85% of the credit and I have a few days left to expiration, then I'm just going to cha-ching, ring that register and move on to the next trade. Now, the risks are, of course, earnings, dividends, splits, takeovers. Look at the Johnson & Johnson trade. The expiration for those options is also the day of earnings. Again, another good reason if I was going to take that Johnson & Johnson trade, I probably would be out of that trade before earnings day. Okay, some final thoughts here. Define your risk with strategic considerations. What does that mean? Well, how are you going to pick your candidates? Weak sectors, trends, things like that. Income generation with high probability. This is that was kind of like that question, right? This is the counter to that question. Do I want to take trades in stocks that are, are in uptrends? No, because those are probably lower probability trades. Right? That's again, but this is more about that trader's preference, that sliding scale in our risk to reward ratios. Timing advantage in range bound or bearish setups. So again, think about your days to expiration, your theta to delta ratios. Is price breaking down from old levels of support? Adaptability to market conditions, maybe waiting for up days to take advantage of increased premiums. Or again, in broader picture, maybe looking at waiting for down days or a down trending market in the broader market. Align your trades with technical analysis. Our strike selections using our technical analysis, our pivot highs, that break even, and looking in lower time frames for some of those candlestick patterns. Looking at our expected move. Where is our expected move and how does it fall inside of our spread? And then selecting higher strike in that higher time frame, those swing highs, those more reliable levels of resistance. And then using net delta and theta, using these Greeks to help us in our setup execution and depending on our preferences. Okay, hope you guys enjoyed that one. Again, this is one I don't trade a lot, but if I have a stock that's in my portfolio that's not performing very well, then I'm going to pick on it and I'm going to try to create a little income on it until it recovers. Or if I'm definitely see a sector that I feel that is being underperforming. Okay, so in the slides, there's that screener that I mentioned, and this is again what Gene was mentioning about our free trial for the 30 days. So normally at this time, I'll show you what's coming up next week, but Gene and I are going to take a little summer vacation, and we're going to be off for the next 2 weeks. So make sure that you sign up, and we will email you the next time our next webinar will be up. That'll be in 3 weeks' time. Again, but under our archive webinars, all of our sessions are archived. They're also on our YouTube channel. And here you can see Earn Income Call Spreads. And if you click on that, there is where you can find the PDF. Boom, right at the top of the hour, Gene. Did I forget anything?
No, I think we're all good, John.
All right, Gene, I will see
Yeah,
you in a couple of weeks. Enjoy the little time off, folks. I hope
same to
that you
you.
guys, yes, you too. Sorry. Folks, enjoy the time away from us as well. Appreciate you all being here today. Until next time, best of health, manage your risk, and the good of all trading.